Let's look to double decline balance depreciation. This method depreciates asset at faster rate than the straight line method. For this method, the depreciation is calculated at twice the rate of the straight line method, which result in larger depreciation expenses in the early years of using the asset. To determine the double declining depreciation method, the first thing we need to determine the depreciation rate by dividing the straight line depreciation rate by 2. If we have the depreciation rate is 20%, that's mean the rates here will be 40% because we doubled these rates. The calculation will be by multiplying the depreciation rate by the book value of the assets, similar to that we have seen in the declining balance method. Third, adjust the salvage value. Don't depreciate the asset below its salvage value. When we get to the salvage value, we need to stop depreciation the asset. We have an example here. We have an asset that we purchased for the amount of 100,000 with 5 years useful life. So the depreciation rate, it will be 40% because we doubled the 20%, which is the rate for the straight line method. So here you can see that in the first year, we get 40,000 of depreciation, which will be 100,000 multiplying by 40%. Then in the second year, it will be calculated by 60,000 multiplying by 40% to remain always 40% as percentage, and we get 24,000. The thing that will be changed, which is the depreciable amount here, we get 60,000, which is the asset value minus the depreciation for the first year, and we get 60,000. So 60 will be the amount that will be base for calculation. Year 3, our base will be 36,000, which is the purchase value, 100,000, minus the 40,000 of the book value for the first year, minus 24,000 for the year 2, and we get 36,000 as base for calculation. Multiplying by 40%, we get depreciation amount for the third year for 14,400.